Let's move on to the tools of financial statement analysis. There are different tools available for analyzing the financial statement, and the tool what we are going to use would actually depend upon the purpose of analysis. What are the tools available? Number 1, comparative statement. Number 2, common size statement. Number 3, trend analysis. Number 4, fund flow analysis. And number 5, cash flow analysis. Let's see one by one. What do we mean by comparative statement? This is basically a statement which will give comparison of net increase or net decrease in the individual items of financial statement. Okay, so this statement will give us the result whether there is a net increase or net decrease for individual items of financial statement. For this, we will be using 2 or more years of information. Okay, so comparative statement is a statement which is going to give comparison of net increase or decrease in individual items of financial statement of 2 or more years of a business concern. It will actually show the actual figures over different period of time with what is the increase or what is the decrease in that respective figures, that too in absolute terms, and the percentage of that increase or decrease will also be given. Okay, the 2 basic comparative statement prepared are comparative income statement and comparative balance sheet. That's about comparative statement. We'll be looking at the format and all in next session. Next comes common size statement. This statement will show the relationship of various items with some common base. Say for example, you take expense as a percentage of sales. You take profit as a percentage of sales. Okay, so this statement will show the relationship of various items in the financial statement with some common base. It is expressed as a percentage of common base. So the common base can be either a total asset, or it can be total equity and liability, or it can be revenue from operations, whatever. And these common size statements, they generally include common size income statement and common size balance sheet. Say for example, we take revenue from operation as base. Look at this. In common size income statement, in income statement, what do we take as base? Revenue from operation. In common size income statement, revenue from operation we take as 100. That whatever be the amount, that will be equated to 100. Then automatically all other various expenses, all other incomes, they will be expressed as a percentage to revenue from operations. So if your revenue from operations is 2 lakhs, and let's say you have some other income 20,000 and you have some expenses of 1 lakh, then what happens? This 2 lakhs will be equated to 100, and this other income, if 2 lakh is 100, what is 20,000? It will be equated to 20. What about this 1 lakh? If 2 lakh is 100, 1 lakh is equal to 50. So 100 plus 20, 120 minus 50, you get profit equivalent to 70, right? So that's how the common size income statement works. Here revenue from operations are taken as 100, various expenses, incomes, they are expressed as a percentage to what? Percentage to revenue from operations. Then if you take common size balance sheet, the total of balance sheet, that is nothing but the total of asset or total of equity and liability, that will be taken as 100. Then various assets and liabilities, they will be expressed as percentage of total of assets or total of equity and liability. And how do we do the analysis here? We will be comparing the common size statement with previous years. We can also compare that with other similar businesses which are having similar accounting policies. Next comes trend analysis. When we say trend, it means tendency of movement. So when we say trend analysis, we are meaning that we are studying the movement of figures over a period, and this trend can be an increasing trend or a decreasing trend, or it can even be irregular one. And whenever we use the data for more than 2 years period, using the comparative statement will become difficult. So in those cases, trend analysis can be used. 1 year, that is the first year, generally will take as base year. Okay, and the figures of the first year will be taken as base year, say as 100, and the figures of other years, figures for the other years, they'll be expressed as a percentage to the base year, and then trend will be determined. Okay, that's about trend analysis. Next comes fund flow analysis. Fund flow analysis, when we say fund, we actually mean working capital. And what do we mean by working capital? This is excess of current asset over current liability. That is current asset minus current liability we call as working capital. And this is also otherwise called as fund. And what do we mean by flow? Flow means movement. Flow means movement. And this movement includes both inflow and outflow. Let me repeat. Fund flow analysis basically measures or studies the movement of the working capital funds. And when we say fund flow analysis, we are basically concerned with preparing the fund flow statement. And this statement will show the inflows and outflow of funds in a particular or a given period of time. And this is very much useful in judging the credit worthiness, financial planning and preparation of budgets. How? Because fund flow statement will show what are the long-term sources, what are the long-term uses. So long-term sources minus long-term uses will communicate what is the surplus or deficit. And this surplus or deficit only will be used for working capital purposes. So if it is surplus, it is good. If it is deficit, then there is some kind of a diversion which showcases credit worthiness. Okay, and it is also helpful in judging the financial planning, how efficiently they are conducting or taking care of their financial management. And it also helps the analyst in understanding or preparing the budgets for the entity. Okay, so that's about fund flow analysis. And finally, cash flow analysis. Cash flow analysis means we are going to analyze the cash flow statement to understand from where they have generated money, where and all they have utilized the money. Okay, so cash flow analysis is concerned with the preparation of cash flow statement, which will show inflow and outflow of cash and cash equivalent in a given period of time. And when we say cash, this includes cash in hand and demand deposits with bank. Cash equivalents denote short-term investments which can be realized within a short period of time without much loss. And cash flow analysis helps in assessing the liquidity and solvency of a business concern. This is what you see in the material, but let me tell you, cash flow analysis means we are going to analyze from where cash is generated, okay, and where cash is utilized. Okay, because for cash flow statement or cash flow analysis purpose, the activities are divided into three. One is operating activity, other one is investment activity, the third one is financing activity. Operating activity should be positive. The positive cash generated can be used for investment activity. It can also be used in financing activity for repaying the loans. Similarly, cash can be generated from financing activity also by raising money from the equity shareholders, by raising long-term loan, and that can be used for acquiring assets, investment activity. Okay, but what is ideal is generating cash from operating activity, use it for investment activity, use it for financing activity also, So understand, if you are generating cash from operating activity and partly using it for investment activity and partly using it for financing activity, let's say for repaying the old loans and all, or let's say for paying dividend and all, it is good. Similarly, if you are raising money from financing activity, let's say from owners in the form of equity, and if you are going to use it for investment purpose, that is also good. But if you are raising money for meeting the negative cash from operating activity, that indicates some kind of a bad sign. Okay, so all those kind of analysis are possible by going through cash flow statements.
Are you a bank executive looking to advance your career in credit or advance profile in SME and corporate banking? Do you want to learn the pre-sanctioned credit and financial analysis skills that are essential for success in this field? If so, then our course, Credit and Financial Analysis Mastery Bundle, for bankers, is for you. In this comprehensive and structured online course, you'll learn the pre-sanctioned credit underwriting process, covering credit analysis and financial analysis specific to SME and corporate banking credit. You'll be guided through each and every step of the process, from understanding the basics of credit analysis to assessing term loans as a banker. With 15 modules and a variety of ebooks and other resources, you'll have everything you need to master this highly sought-after skill. Our course is pre-recorded, so you can access it any time, at your own pace, without disturbing your official working hours. Plus, you can access it as many times as you'd like and even download it to your mobile device for offline viewing. When you complete the course, you'll receive a certificate of completion. And with lifetime Q&A support through our Telegram group, you'll have access to the guidance and support you need to succeed. Don't miss this opportunity to advance your career in credit and financial analysis. Enroll in our course today and take the first step towards a successful banking career.